How do you determine the price of rental real estate so you don't get screwed? Because it's very risky, because the bills will keep coming, and if you don't have enough revenue, you're going to lose the property. Classically, people would do this by simply taking the numbers as deterministic, putting them in and saying that is the value of the property. However, things change and you have to account for that. So the gold standard in doing this and actually valuing anything is a Monte Carlo simulation. Let me show you the spreadsheet. All right, if we open up that Monte Carlo spreadsheet, the first thing we want to go is to main sheet. This is where we're actually going to input any of our data into these beige boxes. So we'd start with the sale price. You would input all the costs that you have associated with a property, which is going to be your taxes, your insurance. You're going to have some vacancy rate, a management cost, capital expenditures, utilities, and then finally your profit. What kind of rent can you make from this property? When you type in your sales price, it gets automatically put into this mortgage sheet. This mortgage sheet will calculate your mortgage. This is based off a 20% interest. Here is the kind of the current APR that I was actually quoted from a commercial lender, and you'll notice that the terms here are more based on commercial loans. If you have 4 or more units in a property, you're going to have a commercial loan, not a residential loan. So headed back to the main sheet, we can see once we put in these figures, what all these happen is that these scenarios get run. We're trying to see not in just 1 year, but what in any possibility will our property generate income or costs, so that we know kind of the boundaries and what we can really expect. Putting in our vacancy rate, 3% is pretty standard. 10% is also standard. That'd be less if you're going to manage it yourself. Capital expenditures, these are not going to be a normal distribution. So when we look into our Monte Carlo simulation, we see I'm using a gamma distribution because it's much more modeling the cost. Right now, for instance, I'm replacing the flooring in my unit, which is going to cost around $5,000. 1 year I had to replace the roof, was closer to $40,000. All these other ones are in normal distributions, and they're drawn from these beige boxes up here. And then lastly, what we'll see is what our cash flow is. This is going to be what that rent was for that year, subtracted from all of the costs. And then we're going to finally have if it was cash flow positive and what the cap rate was. The cap rate is the classic benchmark for rental real estate, and this is kind of determines what your sale price is going to be. So you want to research your local area to see what is the standard cap rate that is current for that property, because that's what you're going to negotiate on ultimately. So let's do a quick example. If you want to find a property, you can first go to somewhere like Zillow, which will have a bunch of listings. You can change your home type, apartments, multifamily, and this will be pretty broad. A more focused website is LoopNet. LoopNet will also have different properties that you can look at and see what type of things you're going for, usually a little more expensive, a little more realistic. But the real fact of the matter is that any property worth buying is typically sold off market. And this is where it pays to have a real estate agent. A real estate agent recently sent me this property in Rochester, New York. It has 15 units listed at $2.7 million. It's in pretty good shape in a decent location, and all of them will have financials. One of the key things to remember is that these financials are usually just bullshit. They kind of make up some figures. So unless you actually find what they submitted for their taxes, then these are going to be largely make-believe. Going into our spreadsheet from that, it was listed at 2.7. So the first thing you would do is put the sale price in there, 2.7 million. And then what's going to happen is that is going to update the mortgage sheet, which over here. So we'll see that the loan that we're trying to get is here at a 6.5 APR over 20 years with a 12 payments per year. It'll tell you how much interest you're paying, what you're paying off in your mortgage. It also breaks up your taxes. This is just from that other sheet divided by 12. So you have a full figure of what that is. And then we look back into our main sheet. All these other numbers stay the same because I actually already inputted this from this sheet. Here we can see that our taxes are here, our utilities, water, garbage, and gas and electric are here. Insurance is make-believe. I'm not even going to put that in there. They also have what you think they can sell. They're always going to try to sell you on this price. That's also make-believe because they're going to go through each one of your units, and they say you can monthly rent, and your monthly rent here for $1,400. They recently listed a property, one of their larger ones, for $1,200. So they don't even believe that it can be rented for that. So we head back here and we first put the realistic number in there. We assume that, it's probably not going to go much lower, but it will go quite a bit higher if we actually raise rents. So we list a realistic rental amount there, and then everything else is updated. So when you look at all our different scenarios, then what's going to happen is up in this chart It's going to summarize what our profit per year is. And we can see that it's actually going to lose so much money on average every year. Here we see in most of the scenarios we're losing around $100,000 per year if we paid this price. And that's just to make sure to pay off our utilities, our mortgage for that, which leads to a cap rate of 2.7, which means that this property is just not even realistically priced. And if you talk to lenders, they would not approve a loan for this property at this much. So let's drop it down to a more realistic number. Let's say 1.7 million. Is that right? So at 1.7 million, all the other figures are staying the same, cost, vacancy rate, and everything like that. And now we can see that our cap rate has gone up quite a bit. It's still a lot lower than what the current industry standards is for Rochester, New York. And we see all this gets put into this distribution, and we see that we're losing more than 18,000 kind of the majority of the time. And we would have to be able to have some type of other income that's actually supporting this property, and we'd expect that this property's value would increase substantially. That's the only reason you would invest in that. And we finally look at the with principal tab. This is going to be kind of a critical tab because it's going to show you what is your actual return on investment. Because what we're paying for this property is $340,000, and we have alternate options we could invest this in. We could invest it in the safest option in some just interest-bearing savings accounts, or we could put it in the stock market. And what we're seeing here is what our return is going to be on this. Now we can say, well, the principal, let's pull that out because we're actually paying the mortgage. That's some money that's really going to us in the future. So we can actually see how often are we actually going to be cash flow positive from that perspective. And here we still see that very rarely are we actually going to be getting any type of positive return, even after subtracting out the mortgage. So at this price, we're going to invest $340,000. We should be expect to lose about 3% a year, which means it would be a really stupid thing to buy this because we could just put that $340,000 into a savings account. So once we get to a more realistic number, I'd probably say 1.3 million. We can see now the cap rate is getting closer to what the industry standard is. We're still going to have to pay some money, but now we see that, okay, if I have maybe a good job or some other positive cash flowing properties, we could probably hold this for a little while. And then we could go through and see, well, what is actually return on investment? Now it's going to be much closer to this, but it's still a lot of work and risk to invest in real estate. So if you're interested in more of the background theory and what a Monte Carlo simulation is, you can find a ton of resources online. Just make sure that you put the data in that's as accurate as possible, because that's really what it relies on. So good luck.